You know that feeling when you check your investment account and see 5 figures for the first time? Like actually 5 figures that start with something other than a 1 or 2. There's this weird shift that happens in your brain. It's not just excitement, it's something deeper. Something that fundamentally changes how you think about money and your future. I hit my first 100,000 about 3 years ago, and I remember the exact moment because I literally had to close the app and reopen it, not because I thought it was wrong, but because my brain couldn't process that I was the kind of person who had that much money. And here's the thing nobody tells you about this milestone. It's not about the money itself. It's about what happens to your psychology when you cross that threshold. Because the first $100,000 is different from every dollar that comes after it, not mathematically. Obviously, a dollar is a dollar, but psychologically, it might be the most important money you'll ever save. And if you understand why, you can use that knowledge to accelerate everything that comes next. Let me paint you a picture of what life looks like before you hit this number. You're saving money. Maybe you've got 10,000 in your account, maybe 20. You're doing everything right. You're budgeting, you're investing, you're being disciplined, but every month feels like you're pushing a boulder up a mountain. You save $500 and it barely moves the needle. You get a raise, and after taxes it's not as life-changing as you hoped. You feel like you're working really hard and getting nowhere fast, and then something weird happens when you cross into 6 figures. That same $500 contribution, suddenly it feels different, not because the math changed, but because you're not starting from zero anymore. You're adding to something substantial. You're building on a foundation that actually feels real. Here's what's happening in your brain during this shift. Below 100,000, you're in what psychologists call scarcity mode. Your brain is constantly calculating whether you have enough. Every expense feels significant because you're measuring it against a relatively small pile of resources. When you've got 15,000 saved and your car needs a $3,000 repair, that's 20% of everything you have. Your brain treats that as a legitimate crisis. But when you've got 100,000 and face that same $3,000 repair, your brain does different math. That's 3% of your total. Annoying for sure, but not a crisis, not something that fundamentally threatens your security. And that shift from crisis mode thinking to nuisance mode thinking is massive for your mental health and decision-making ability. There's actual neuroscience behind this. Studies show that financial stress activates the same parts of your brain as physical pain. When you're worried about money, your amygdala lights up. That's your fear center, the part of your brain responsible for fight or flight responses. And when that's firing constantly, it's impossible to think clearly about long-term strategy. But here's where it gets really interesting. Research found that having savings above a certain threshold actually changes your cognitive function. People with substantial emergency funds perform better on tests of executive function, problem-solving, and long-term planning, not because they're smarter, but because their brains aren't being hijacked by financial anxiety. So when you cross that 100,000 mark, you're not just achieving a financial milestone. You're literally upgrading your brain's ability to make good decisions. You're freeing up mental bandwidth that was previously consumed by worry, and that bandwidth, you can redirect it toward growth, opportunity, and building even more wealth. Let me tell you about something that happened to me about 6 months after I hit that number. I got a job offer, better position, better company, but it required relocating to a more expensive city. The salary increase was solid but not huge. Before I had substantial savings, I would have probably turned it down. Too risky, too much uncertainty. What if it doesn't work out? What if the cost of living eats up the salary increase? But with 100,000 in the bank, I took it, not recklessly. I ran the numbers, but I wasn't paralyzed by fear, because I knew I had a cushion, I had options, and that job turned out to be a career accelerator that probably bumped my lifetime earnings by $500,000 or more. All because I was in a mental state where I could take a calculated risk. That's the thing about this milestone. It doesn't just change how you feel about emergencies, it changes how you approach opportunities. When you're living paycheck to paycheck, or even when you've got 30,000 saved, every opportunity comes with massive anxiety. Can I afford to take this chance? What if it doesn't work out? How will I recover? But 100,000 creates what I call opportunity freedom. You can invest in yourself, take that course, attend that conference, start that side business, all without feeling like you're gambling with your survival. And here's the kicker. Those opportunities are what accelerate wealth building beyond this point. The person who can take smart risks will always outpace the person who's stuck playing defense. Now let's talk about something most finance people won't tell you because it sounds too much like self-help nonsense, but it's real and it matters. Your identity changes when you hit six figures. Before that moment, you might have thought of yourself as someone who's trying to build wealth, someone who's working toward financial security. That's future-focused identity. You're not there yet, but you're trying. After you hit 100,000, you become someone who has wealth, present tense, not rich, obviously, but wealthy enough to have meaningful options. And that identity shift affects every financial decision you make going forward. You start thinking like someone who has money rather than someone who's chasing it. And those are fundamentally different mindsets. People who have money think about preservation and growth. People who are chasing money think about not losing what little they have. The first group takes calculated risks. The second group avoids risk entirely. The first group invests in opportunities. The second group hoards cash because cash feels safe. See the difference? Here's a practical example. Let's say there's an investment opportunity that requires $20,000 upfront, could potentially return $50,000 to $70,000 over 3 years. Solid opportunity, reasonable risk. If you've got $25,000 total in savings, there's almost no chance you're taking that deal. That's 80% of everything you have. Way too scary, but if you've got $100,000, that same $20,000 investment is only 20%. Still significant, not something you do lightly, but psychologically possible. You can afford to take the shot because even if it fails completely, you're not starting over from zero. You've still got 80,000 working for you. This is why the rich get richer, by the way, not because of some conspiracy, but because having money makes it psychologically possible to take the kinds of calculated risks that generate more money. When you're broke, you can't afford to take chances. When you're comfortable, you can afford to be strategic. And here's something that surprised me. The difference between 50,000 and 100,000 is way bigger than the difference between 100,000 and 200,000. I know that sounds backwards. Twice the money should be twice the impact, right? But it doesn't work that way psychologically. Going from 50 to 100,000 is crossing a threshold. You're moving from I have some savings to I have serious money. That's a category change in your mind, but going from 100,000 to 200,000, that's just more of the same category. Don't get me wrong, it's awesome and it matters, but the psychological impact is nowhere near as dramatic. Think of it like temperature. Going from 32 degrees to 64 degrees is life-changing. That's frozen to comfortable. But going from 64 to 96 degrees, that's comfortable to hot. Still a change, but not a fundamental shift in what's possible. The first 100,000 is your freeze to comfortable transition. Everything after that is degrees of improvement within comfortable. Now I want to address something that might be making you uncomfortable right now. Maybe you're nowhere near 100,000. Maybe you've got 5,000 saved, and this number feels impossibly far away. Maybe you're thinking this whole conversation is irrelevant to your situation. I get it. I've been there, and I need you to hear this. The principles that get you to 100,000 are exactly the same principles that get you from 0 to 10,000. It's just that the first chunk is the hardest, because you're doing it with scarcity mode brain. You're pushing that boulder uphill with limited mental bandwidth, and that's actually an argument for being even more intentional about your early savings. Every dollar you save before you hit that threshold is fighting against psychological resistance that won't exist later. So if you can develop strong savings habits now, while it's hard, you're building discipline that will make everything easier once you cross over. You're training in weighted clothing. When you finally take the weights off, you'll be amazed how fast you can move. Here's what this means practically. If you're in the building phase, below that 100,000 mark, your number one job is creating momentum, not optimizing for the absolute maximum return. Not trying to find the perfect investment, just consistent, steady progress, because the real victory isn't investment returns at this stage, it's psychological momentum. Save aggressively. Invest in broad index funds. Don't overthink it, just keep the boulder moving uphill. Because once you crest that hill and hit six figures, gravity starts working in your favor instead of against you. The compound interest that felt invisible when you had 15,000 in the market becomes very visible when you've got 100,000 invested. Let me show you the math on this because it's actually wild. Let's say you're getting a 10% average return, which is roughly what the stock market has done historically. On a $10,000 portfolio, 10% is $1,000 in a year. Nice, but not life-changing. You could make that in a week or two of overtime at many jobs. On a $100,000 portfolio, 10% is $10,000. That's real money. That's more than you could save from your salary in a year for a lot of people. You're not just saving anymore. Your money is doing significant work on your behalf. And psychologically, that's when investing starts to feel real. when your returns in a good year exceed what you could physically save from your income. That's the moment you realize you're not just trading time for money anymore. You're building a machine that generates money while you sleep. And once that clicks, once you see your investments generate more in a month than you could save from your paycheck, your entire relationship with money transforms. You start thinking about money as something that works for you rather than something you work for. And that might be the most important shift in the entire wealth-building journey, because it changes you from someone who's stuck on the treadmill to someone who's building systems. Here's another psychological effect that shows up at this level. You become much better at distinguishing between wants and needs. When you've got limited resources, everything feels urgent. You need a new laptop because yours is slow. You need a better car because yours is unreliable. You need new clothes because you want to look professional. Everything gets elevated to need status because you're operating from scarcity. But when you have substantial savings, wants can just be wants. You can acknowledge that you want something without pretending it's a necessity. And paradoxically, this often leads to spending less, because you're not emotionally driven to justify purchases as needs. You can evaluate them rationally as wants and sometimes decide the want isn't worth the cost. I've noticed this in my own life. Before I had significant savings, I would convince myself I needed all kinds of things. After I crossed 6 figures, I found myself saying no to way more purchases, not because I couldn't afford them, but because I didn't need to use shopping as a way to feel secure or successful. I already felt secure. The money in my account did that job. This is why you'll often see people who built substantial wealth driving normal cars and living in modest homes. Not because they're cheap, but because they don't need external status symbols to feel wealthy. They know they're wealthy. They see it in their account balance, and that's enough. Now let's talk about something that happens around this milestone that most people don't anticipate. Your relationship with other people changes. Not always in good ways. Some friends might get weird when they know you've got money saved. Family members might start asking for loans. You might notice a subtle shift in how people interact with you. This is uncomfortable but important to understand. Money triggers deep psychological stuff in people. And when you have it and others don't, it can create tension, not because you're flaunting it, just because it exists. Some people will project their own financial anxiety onto you. Others might assume you've got it easy now and minimize your continued struggles or stress. The healthy response is boundaries. You don't owe anyone access to your finances. You don't have to explain your choices or justify your success. And you definitely don't have to play small to make others comfortable. Your financial progress doesn't diminish anyone else. There's no scarcity of opportunity here. But be aware that this dynamic exists, because it can sabotage your progress if you're not careful. I've seen people slow down their wealth building because they felt guilty about doing better than friends or family. That's not noble. That's just self-sabotage that hurts everyone in the long run. Here's something else that becomes crystal clear at this milestone: the difference between income and wealth. Before you have substantial assets, you tend to conflate the two. You think about getting rich in terms of making more money. Higher salary equals more wealth. Simple equation. But once you've got 100,000 invested, you realize they're completely different things. You might have a friend who makes twice your salary but has nothing saved. Meanwhile, you're building actual wealth. Your net worth is growing while theirs stays flat. And you start to understand that wealth isn't about what you make. It's about what you keep and grow. This realization changes your career strategy. You stop chasing the highest paying job and start thinking about total compensation, work-life balance, and whether a position gives you the time and energy to manage your investments well. Because at this point, your investments are becoming a meaningful contributor to your net worth growth. They deserve attention and strategy. Let me share something personal. When I hit 100,000, I actually took a job that paid less than my previous one. Sounds crazy, right? But the new job had better benefits, way less stress, and a schedule that gave me time to pursue side projects and manage investments actively. That decision probably cost me $30,000 in salary over 2 years, but my net worth grew by $200,000 in that same period. Why? Because I had the mental space to make smart investment decisions. I had time to learn about tax optimization. I started a side business that's now generating significant income. None of that would have been possible in my previous high-stress, high-hour position. That's the kind of strategic thinking that becomes possible once you're operating from a position of financial security. You can optimize for total life value rather than just maximizing income, and paradoxically, that often leads to more wealth, not less. So here's what I want you to take away from this. If you haven't hit 100,000 yet, understand that you're in the hardest phase. You're building against maximum psychological resistance. Be patient with yourself. Celebrate small wins. Keep the momentum going. Because once you cross that threshold, everything changes. And if you're already past this point, think back to what it felt like before. Use that memory to stay humble and help others who are earlier in the journey, because everyone who's built wealth started exactly where they started. With nothing and a decision to begin, the first 100,000 is different, not because the math is different, but because you are different when you have it. You think different, you act different, you take different risks and see different opportunities. And that difference compounds into everything that comes after. So whether you're at 5,000 or 50,000 or already past the milestone, understand this. You're not just building an account balance. You're building a completely different relationship with money, opportunity, and your own potential. And that might be worth more than the money itself. What's your experience been? Are you working toward this number or already past it? How did it change your thinking? Drop a comment because I'm genuinely curious how this milestone hit different people differently.